All right, so we'll start this off with a note from Sven Henrik. He's a chartist based out of the UK, but he follows the market in America. He does a lot of the charting like I do, try to find patterns, and his most recent pattern was this NDX. This is the Nasdaq, and he noticed going back to 2009, there's crashes, and we're basically at bottom points, and we're if you draw a line at the bottom, we're basically at that bottom right now, and it's holding. This is a long-term trend. This is monthly chart for the Nasdaq, and I've never actually done this. We'll have to start doing this from now on, but this is really neat. So he traced it back to the 2009 crash and the COVID lows, and now the lows we have now. So he said, mind-blowing example of how relevant long-term trends are. We haven't been doing that. We'll start the two most profound lows in recent memory, the great financial crash down here, and the COVID lows crash right here. And what just happened in October, the perfect tick, we went down to that low. So we can basically see that there is some support here long term. And he said nothing is broken at this point. But if we go below that, then everything's off the table. The other thing he said in a different chart, he was mapping out long-term trends going back to 1998, 2000. And he mentioned different ways that we could go in the next year. And these are like, you can go back down to here, and go up, and then go back down to here, go up. These are all trends. This is resistance from prior years. This is, support. All these lead to different scenarios. So, we're gonna follow this, as the year progresses and see if we see any of these patterns. But he said in each of those instances, we go up from there. So if we are in a crash situation where we're out of control, we look at these lines of support to see if that has any credence. Right. He says, meantime, choose your roadmap for the landing. Oh, no. I hope it doesn't do that. But, okay. Let's look at some of my notes. Let's look at what's going on in the stock market right now. And take a look at the meeting notes here. Okay, well, we'll go with what's in the stock market. Hold on. Okay, stock market is basically flat today. Okay, so I'm going to go. Okay, so basically the news for today was we had EPI report, and it was stronger than expected. So the reason why we would normally expect the stock market to go down if the PPI was strong, because that means the Fed would have to raise rates more. The 10-year, we have that formula that's been working pretty good. The 10-year goes 10-year. Okay, we expect it to go up today because there was a hot PPI report. That means inflation it's falling, but it was stronger than expected. So that means the rates for both the U.S. Treasury, you can see that from this Treasury, we were down here yesterday, and because we had a hot inflation report, both the 10-year and the 2-year went up. So our formula is the 10-year. We're down from last week, but with that hot inflation print, this is why the stock market was going up this week, because it was the interest rate, the 10-year, 2-year were going down, the rates. But this kind of changed that. So if we map the 10-year and the 2-year to the stock market, it's inverse correlation. So that's good. We're following that. That's the big thing that happened today. We had that report came out. And if we look at our map, our calendar, we see that next week we have a CPI report. Today was the PPI report. We have two very important things, Tuesday and Wednesday. The CPI report and the Fed meets. They're going to raise interest rates. And what we're looking for, what the stock market is looking for, is 3 words: parity, neutral, or we're going to wait. If they say we're going to raise rates a little bit more, not as much, that's going to make the stock market go down. And if the Fed says parity, neutral, we're done, we're going to wait, see what happens, then we're going to have a Christmas rally. So unfortunately, we're at a Fed watch right now, because everything the Fed does, and with interest rates, it's basically an inverse correlation for the stock market. So let's see. Let's look at the stochastics for where we're at in the stock market. Okay, you see we're oversold. Chuck told me yesterday, we're oversold, and I didn't even look at it for a while, but yeah, we're right there. We're oversold. And we're at the bottom. We've established a new trend line in the S&P. We're making lower highs, higher lows. But we're like at a decision point right now. We're oversold, but we're still at basically at the top of this downward trending channel. So it's a major decision point, and it's all coming to this Fed meeting on Tuesday and Wednesday to tell us what's going to happen next. All right, so let's look at more the calendar, what we're looking forward to. We know from our notes from a couple weeks ago, that there's no statistical correlation to the stock market going up the week before Christmas, but the week after Christmas is significantly a good week. And there's a lot of end-of-year window dressing, a lot of end-of-year things going on. So pensions buying things. So we're looking forward to that. But next week, we don't know. It's all based on what's happening in 2 days. All right. So here's our points that we're keeping in mind. The 2-year and 10-year went down 2 to 3% this week. Well, after today, it's 1%. And we still have the Fed reducing the balance sheet. This is all causing pressure on the stock market. We don't have any earnings until the end of January, so we can't rely on any of that for helping the stock market go up. China is loosening COVID rules, and so that's good for the stock market. Improves the supply of things to Apple. A lot of people that count on China for sales, such as Starbucks. They have a big presence up there. Nike does retail sales in China. Dollar is down another 2%. This is getting really good for some of the big tech stocks and big multinational companies. The farther it goes down, the better it is. Let's look at we're in a downtrend with the DXY. So it's making lower highs, lower lows. The farther this goes down, the better it is for the earnings of the major multinational companies. So that's working in our favor for the stock market. And we're currently oversold. We looked at most of the charts, most of the stocks we're following now are oversold. and we're at bottoms of our current trend lines. So what's going to happen next week if we have good information from the Fed, break out of this? If we don't, looks like we're going to go back down here. We don't know. But we're still oversold, and we have a couple weeks to go before the end of the year. So my guess is we're probably going to be breaking out of this up to here if we have good news from the Fed. So we have oversold, and we have a catalyst on Tuesday. But I left it blank because we have no idea what's going to happen that day. Now, what else is happening here? Okay, so if we mark the goods and the bads, we have more good, more green than red on the screen. So it looks positive for the stock market going the next week. Any questions about that? All right, so major variables in the stock market. Crude is down 11%. What was it, a month or two ago, we were seeing in a recessionary environment, the price of oil go down to 70. It looks a lot like we could be going to a slowdown, and I'm surprised with China reopening. That would increase the demand for oil, and that would make the price of oil go up. But that's not happening. So that's an interesting thing to happen. I mean, but for the energy stocks that have been in an uptrend for such a long time, they are now. Let's look at the stochastics for the XLE, because it's XLE. Okay, we've been in an uptrend all 2000, all this year, and right now we're oversold, and the price of oil is going down. We know from the price of gas is going down. This could be a break of trend, and we might be. This could be very dangerous to think that this is a momentum trade going forward, because it could be a trap and it could start making lower lows now. So I don't know. With the price of oil, I think this sector just follows the price of oil. So we'll see. And okay, inflation's after today's print, it's around 7.4. It's going down, but it's falling. There's year-over-year comparisons, and last year at this time, it was a hotter read than expected. So I think what's happening with these inflation reports is the year-over-year comparisons are getting better, and that'll make it make it seem like inflation is not increasing as much year over year. Dollar is going down another 2%. That's really good for the multinationals, and it's in a downtrend. But the price of oil is going down, and the price of and the dollar is going down. But those are good for the stock market. Okay, let's look at what the sectors are doing today. Oil is the main. Oh wow! Let's look at the price of oil. Let's look at what the price of oil did today, this morning. It's down a little bit. Okay, so I think what's happening is there's basically a momentum trade. We just saw it in the XLE. It very well could be people are getting out of this momentum trade, and it's worked for such a long time. Now, the economy, we're going in recession, the price of oil goes down with that. And it just could be a rush to the exits for energy-related things. And look, these are all things that did the best this year, and they're all the ones that are going down the most today. So we have energy, we have retail, we have oil, and healthcare. healthcare plan. So look at the ones that are doing the best. Gold miners, not going to comment on that. Real estate index fund, semiconductors. Okay. Well, they're not going up a whole lot, so it doesn't really tell us much. All right. Let's look at, hold on for a second. Let me pull something up. Work it. Okay. Hold on for a second. I'm trying to get something. Okay. Matthew, do you have a comment on this one?
I was just the home sales decrease seemed very sharp there. Yeah, so you can see the 2020 when there was the original pandemic, and then bounce back. You know, as people were buying homes, but now it's gone. With the interest rates going up, it's gone down very steeply. Existing home sales, right? These are, I think, existing homes or
Pending home sales index. Under contract to be sold.
Yeah, I don't know if it's new homes or this is just existing homes, but yeah, it's just a very interesting drop there.
Right. So, so I guess it's almost a 1-to-1 correlation to interest rates from this point forward.
Yeah, I do. By interest rates, so I don't think people aren't able to make their payments. I'm not sure, like adjustable rates. You know, how many of them are adjustable rate, but that'll be a few years, I think, out. But
right.
In terms of new sales, people are not moving around as much.
Right. So I guess what we can take from this is, I guess a lot of investing is looking at these big factors that, you know, that matter a lot to companies and predict when they're going to peak. Like if we go back on our calendar, and let's go back on our calendar and say when are the interest rates going to be peaking? Maybe right here, right? That would probably be the last raise. Maybe a month after that, maybe no. How long would it take for people to be interested in houses again? If we're looking at housing stocks, maybe 6 months, because then maybe 6 months after they raise, they'll have enough confidence to start buying again, or maybe they'll be reducing the rates in 6 to 12 months. I don't know, but part of investing, I guess, is kind of trying to time the major variables that we're following. Let's say these oil. Like we were trying to predict $70 oil when it was 100, and if we could have predicted that, we would have said, well, we're going to wait to buy our energy stocks until it gets $60 a barrel, right? And the same thing with housing stocks. We were talking about how they were wiped out. They were down 40% at some time this year, and we have to basically look past the current interest rate environment to see what kind of long-term demand there is. And the way Warren Buffett was saying, he has a big part of his business in mortgage. I mean, Berkshire Hathaway real estate company. So he was saying, you know, the demand, you have to increase the demand for housing, and either you allow people to buy houses earlier, like when they're teenagers, or you have more people, more population, you know, there's different ways to look at it, but I guess part of what we're doing is try to predict, you know, when, you know, some of the key factors are going to be moving one way or another, and then then dollar cost into investments that might take advantage of those that situation. So right now, housing stocks are still pretty much. Let's look at some of the home builders. It's flat. It's flat today. But look at some of the. Let's look at some of the stocks that are. Those are baby firms. It's recovered a little bit from its lows. We were talking about it, right about here. Okay, so if it ever gets down to 25 again, we know that's a it's the long-term bottom. I mean, but there's some support there. But it's in an uptrend right now. You can see it's making lower highs, lower lows. It's almost back to where, if it gets backed up to here, to 41. Let's look at some of the long-term. 28 has support there. We'll support at 33. Okay, but it's interesting to maybe in a year, year and a half, maybe a year, this will recover to these levels because the interest rates went back to normal. I don't know, but I guess that's all I can talk about for this. But that was an interesting thing. Thanks for sending that over, Matthew. You also mentioned about how the housing demand is collapsing. Housing market is collapsing right now. So I guess one thing to think about is, if the housing market is collapsing, would we want to look into, maybe investing in housing? Like right now, I already have a house, but I'm actually looking at investing in a house that's possibly half price because there are people that can't afford to continue with a project that's halfway through a renovation. So there's going to be a lot of that happening. And maybe part of your investing, in the next year is taking advantage of housing that's half price. I don't know. But right now, any comments on that?
Well, adjustable rate mortgages might be more interesting than they were when the rates were at really lows. Because you can get a better rate with it, and if you think that rates are going to go down in the future, then it's fine to get an adjustable rate.
All right. Yeah, that's interesting. All right. So let's go back to more what's happening in the stock market. Yeah. So let's look at the stocks that are going up and down today. Okay. The theme here is, okay, we're exiting there's a huge rush out of oil. So the momentum trade is kind of collapsing for oil. We were talking about this for a while. If you have a trend that's been going up, you gotta wait for it. Energy, right. This has been in an uptrend for almost 2 years now, the XLE. And we know in a recession, price of oil goes down, so that's a negative for this. And we have, it's been a leader for a whole year now. And we said last year in December, the leaders of this year is not going to be the leaders next year. And so last year we saw tech as the leader. We flipped the tables and said tech is going to be the worst next year. No, we basically said the worst of this year is going to be the leaders of next year. So what's happening right now is people are getting out of this momentum trade. This could be a break and getting into the next momentum trade. It very well may be tech. Look what's going up. This is Netflix. Stocks with traditionally high PE ratios. Tesla, overvalued companies, Lumen. Okay. And the ones going down the most are the high using energy, mostly energy, healthcare. So we have healthcare and ones that did the best this year. So we're kind of flipping right now, maybe at the end of the year, where people are adjusting to that theme that we did last year. Last year we said healthcare could be a sector that goes up the most because it lagged for the past couple of years. And this year it could be, we haven't done that prediction yet. What's going to be good next year? What's going to be bad next year? But it just, a lot of times it follows that pattern. Whatever did good this year is going to be doing, it's going to flip, and maybe tech's going to be good next year. Okay, so we're seeing that today. Let's see what else is happening in the NASDAQ, DocuSign. They had a good earnings report. That's why they're up. They're a really expensive stock. Broadcom. This is an interesting one. Broadcom is up a lot. It is one of the stocks, AVGO. Let's look at the financials on this. This is a tech stock. It pays a dividend. Let's see, the dividend is showing dividend 3.09%. Let's look. 3.12%. So it's a decent dividend for a tech stock. Okay, so on top of that, the PEG ratio is 0.84. That is undervalued by 20%. It has profit margin. Wow, this is a really good stock. You should start following this. Return on equity is 44. And it only has a PE of 13. So this is an example of an undervalued stock that's out of favor right now. Why it's out of favor? Let's look. Anyone know why Broadcom could be out of favor?
No, but I was wondering. Usually you show us the projected earnings, over the next year or two.
Let's look at that right now.
To see if their earnings are collapsing or something.
Yeah, I think it's because there's talk that Apple might not be using, their. Well, I think Apple is a major customer, and there's talk that they're going to use them, not use them, and when you have big accounts and rumors, people sell it off and then ask questions later. I think let's look at ATG. Oh, so what they do is they make components for phones for the majority of what they do. I think they're a chip company. They're been out of favor, right? So we have a combination where technology is starting to get back in favor. That's a catalyst. They're down a lot. They're undervalued. Let's look at their earnings. I heard about this, on some of the stock shows, but I never had a chance to research it. But no, it doesn't have much guidance.
AVG is a good company.
40.68 divided by 43.45. It's only grown at 7%, according to this. And they only go out 1 year. Oh, no, let's look at 22, 23. I missed that. 27 points divided by 40.68. So they're growing, let's say, 7 or 8% a year. That's consistent. So if you look at their PE ratio, if they're growing at 7%, the 4P is 13. They're still 2 times overvalued. I'm not sure where Yahoo gets that from. I don't know if we can count on these numbers, but just based on those numbers, it seems a little overvalued. But I guess we have to see what the story is. Why is it down? Let's look at the chart just for the last little piece there we're missing. Okay, so it's basically following the S&P 500. You can see it has this downtrend, lower highs, lower lows. It broke out of that downtrend right here, and it's this is the resistance from the past. It's almost going to hit that resistance from from August. I don't know. It seems like it's broken out of that downtrend. Maybe that all tech stocks will start. Now, if you look at the moving averages, let's look at the stochastics for the S&P. You can see that the S&P is starting to trade above its moving averages. This is the 50-day, the 100-day. Now it's approaching the 200-day. So you have all these decisions coming into next week. We're hitting almost every stock is almost at its 200-day moving average. If we can start this 200-day moving average going up, and stocks, the majority of stocks are above the 200-day moving average, and we're oversold, that's whenever you get some momentum, and stocks in the S&P have a momentum trade. But we're not there yet. We can very easily go down to here if we get some bad news. So we'll keep our eyes on that. But it seems like we have a regime change in the stock market from what's worked this year to what's going to work next year. I don't know. All right, let's look at more things. Okay, you mentioned the DXY is still going down, another 2%. So we're following this. It keeps making lower highs, lower lows. That's going to improve the earnings for all the tech stocks, and that's going to increase the earnings projections for the tech stocks. We're getting less greedy. As the stock market goes down, we're getting into fear, extreme fear. So right now we're still greedy, but we're in greed 57. Last week was 65. So 1 week ago, 67. So as the stock market goes down, greed gets less, and then we get towards people that are fearful. And when it gets fearful and extreme fear, that's an indication that we're almost going to go up again. So let's look at the VIX. The VIX is the 22. So it's going up. The interesting thing about the VIX, it doesn't want to close below 20. It doesn't. There's just this level where people, when they see the VIX get down too low, the stock market starts going down, and that's inverse correlation. So right now we just have a complacency. It's not fear. It's not greed. It's basically in the middle. Can't get anything from that. Missing. So I just wanted to post some of the stocks that are still in uptrends that have been working all this year, and they're still in uptrends. One is Pepsi. Pepsi has been able to increase their costs, increase the prices, and they just started firing some people in their front offices, but it seems like that's a stock that will continue to do well in this environment. It's conservative with a big dividend. You see Starbucks. I guess Starbucks will be helped by the China news, where they're relaxing the COVID restrictions, and it's an affordable luxury for people that are in a recession that can still afford a cup of coffee to feel better. And waste management, it's still in this uptrend. There's consistent demand for garbage collection, even in recessions. And Walmart, we should have looked at it more when it went down 15% in a day. Next time one of the stocks we're following goes down a lot in a day, we should have been thinking that Walmart does good in a recessionary environment. But we'll be ready next time. And the other one is T-Mobile. They're kicking everyone's butts in the phone business. And they're making higher highs, higher lows. And they're approaching the bottom of their channel. And almost oversold. So maybe next week they'll be down at this trend line and totally oversold. They're growing at 30%, while AT&T and Verizon start losing 5-10% of customers a year. All right. Okay, Morgan Stanley, there's people that say you can't take these strategists calls seriously. They say it's a bear market, it's going to happen, and it's not going to happen. But I guess what you got to do is just have to understand the next year is going to be kind of flat with the stock market. It's not going a whole lot. It's going to be a recession means you don't have as many, the economy is slowing down, and you don't have as many sales. You don't have as good earnings reports. So, but we're trying to predict it too. When's the recession going to be over? He said it's going to be over around St. Patrick's Day, and the bear market. Okay, they're the number one institutional ranked portfolio strategist. That's pretty good. Some probably over in sometime in the first quarter. I think tactical rally is going to be big enough to try to pivot the trade. So what we're doing is we're trying to we'll use this kind of information to temper our strategy when we're looking at our calendar. So we were saying we're trying to map out when the end of the recession is, and we were saying a couple of weeks ago the end is going to be probably in April, and maybe according to Morgan Stanley, it's going to be May. So right around here is going to be when the pain stops. Maybe right here, March, April. And the more really important people, companies that actually try to confirm that, the better it is for your tempering your expectations in the stock market. So if we know it's going to pretty much bottom out here, we have to expect some pain in the January and February times where the stock market isn't going anywhere or going down. All right, that was good. Little article put on. Okay, so the stock market was actually going to open positive today. I was following the futures before this PPI report came out, and as soon as that report hit, the Treasury went up. It was down. The Treasury went up, and stock market futures went down. So there's a huge correlation to the inflation to where the stock market goes. But let's see. But the interest rates are going down, even though they went up today. They're trending downward. And all right, is there any questions about any of this? All right. All right. So what I did just is I made a screen, because every once in a while, maybe every month or two, it's good to see what stocks follow into our screener. So what I did was I did a screen for stocks with low PEG ratios and long-term growth that are positive, return on equity, and cash flow that's positive, large market caps, companies that are actually growing, and price to earnings that are positive, and return on investment that's positive. So I did run the screen. Whenever you run a screen, I sorted by market cap. That is market cap. The larger companies are more reliable. And then after I did that, I picked out all the good numbers from each of these columns. So for return on equity, or return on equity, we'd like to have something above 13. But if there's something 145, that's what we're going to start. And we're going to highlight for cash flow growth. 7 is nice, but we want the ones that are highest. So what we're looking for here is revenue growth. It's 50%, right? So we see. What I did was I made exemplary numbers, I put them in red. And then after I'm done with this, I say, okay, which ones have the most interesting numbers? And so this one, ExxonMobil, seems like it has a lot of red boxes. Their return on equity is 30, that's great. Long-term growth is 25, that's great. I did that same thing with Tesla because they have return on equity of 30. Everything kind of lines up really good with that one. And we'll look at Charles Schwab too because they seem to have a lot of good numbers that we're looking for. And so the problem is we have a lot of energy stocks. But those energy stocks, Chevron, ConocoPhillips, but they're all based on the price of oil. And they've been growing a lot this year because the price of oil goes up. The only problem is they have no control of the price of oil. And if it goes down, they don't earn as much. So just because, just for example, I mapped out ExxonMobil and Tesla and Charles Schwab just to see if we find anything good in this screen. Other things, we can look at why some of these other ones might have a good thesis. Let's look. Let's look at, we were talking about healthcare stocks because in good times and bad, people still need healthcare. This is one of the largest health providers in the world, country. I think they're the old Aetna now. Aetna is one of the major providers. Then there's Blue Cross Blue Shield, and this is the third one. The air would do good because as there's problems in Ukraine for getting exports for corn, you have American farmers investing in farm equipment, and that's a good thesis for that company. You see, and around the world, they sell around the world. Merck, that's a current thesis for that is that people still take drugs, good time and bad, and they have to pay a dividend, which is good for this environment. If we're not growing at all next year, then we'll at least collect dividend. So we're looking for dividend for investment next year. And Visa, we already follow that. We know that they have return on equity of 45 because they run servers and they have very low cost of doing business. So that's all their numbers are good, 20s, 16s. They're a little bit expensive, but the MasterCard follows Visa in valuations, like almost exactly. All right, so what I'm going to do is I'm going to focus on 3 stocks: Tesla, ExxonMobil, and Charles Schwab. First one is Tesla. Okay, so Tesla currently is a PEG ratio of 1.4. That means it's 1.5 times overvalued. It's down 50% this year, but it's still overvalued. So let's look at the forward PE is 31. I did a calculation for the next 3 years. It's growing about 20%. The PE of 31, it's still 1.5 times overvalued. If you trust these earnings estimates, you can see that the earnings estimates go out a couple of years. But I'm still worried about this third year. They're only growing at 7%. But they're growing they peaked probably in this year, and after that they're a normal car company, perhaps. So that's kind of scary thing about Tesla, unless they have a new market, or with Elon Musk having so many distractions, it's going to be real hard for him to put some extra effort to make this company do more than sell cars. Okay, so that's still overvalued, even though it's down 50% this year. Let's look at ExxonMobil. This company is trading at a PE of 9, tech ratio of 1.8. So the return on equity is good, profit margin is good. And let's look at the earnings estimates. As soon as I looked at it, I said, what? They're scheduled to go down the next 4 years. I said, I'm not even looking at that now. I mean, why would you invest in a stock where the earnings are projected to go down? Maybe this is because of the price of oil that peaked, and they're just going to have decelerating earnings. Look, they went up a lot, like doubled in when the price of oil went up. The people that are predicting the price of oil for the next 3 or 4 years are going to say, um, I own it for a dividend. I bought it like 5 years ago when the price of oil was down, but I'm buying and holding it, knowing it's probably going to be a flat investment over time. But it's all at the mercy of the price of oil. So it's not a growth stock, even though in our screen it said return on equity. Yeah, that's great. Long-term earnings growth 25%. I don't know. That's if the price of oil keeps going up. It's not. I mean, the analysts say it's not going to. So actually, that's not that great of a stock after all for growth. It's just like an income stock right now. Let's look at Charles Schwab. This has a PEG ratio of 0.85. That is 15% undervalued, according to Yahoo. Its 4P is 16, and the profit margin is good, and the return on equity is good. Okay, let's look at the business model for Charles Schwab. They make most of their money probably by lending money to borrow on margin for their clients and offering services to their clients, because they don't make money, and they make money by order flow. Those 3 things. They bought out PD Ameritrade recently, so they have like almost a monopoly in having a lot of multi-trading people. But they have, let's see. Okay, so let's look at, we know how they make money, but let's look at their earnings projections. They're scheduled to grow 25%, 15%, and 7%. So they're growing probably around 15% if you take an average of that. So that means if their hit ratio is 15, they're basically fairly valued. And if you want a stock that's growing at 15% a year, that is paying a dividend, very small dividend, they pay a dividend. It's not compelling enough for me right now. It's barely valued. I like to buy a stock when it's half price. So we'll keep an eye on this if it ever goes down, for whatever reason. We'll know it's at least fairly valued where it's at right now. So let's see. Let's look at this. It says its long-term earning EPS growth is 20%. We have 15%. Cash flow growth. Okay. And revenue growth. Okay. There's a little rosy. We thought it was going to 15%. But let's look at its competition. Their competition, Robinhood, all the big banks, JP Morgan, Bank of America. Seems like all the smaller brokerages have been bought up by other companies. So there's not that many remaining. So, and they bought out, companies too. So I guess you're going to have 1, 2 or 3 big brokerages in the end. So they have less competition. Let's see. All right, that was interesting. Okay, let's look at our emotional, where we are on this. Right now, we're still, if we look at our S&P chart, we're still, people are excited. People are greedy. They think we're going to go back and hit new highs, but we're still in a downtrend. So you have to prepare yourself. Right now, we're at this new paradigm. We're going to break out of this. Just when that happens, we have capitulation, despair, and there are people that say we're going to make one more break down to here, and then it's up. This is why I started the whole talk with Sven, Mark, talk about this S&P chart. He thinks we're going to go down, to this, this low right here in the chart, right here, and then we'll go up. We can do that, or we can go down even lower, which is down here. We don't know, but it just seems like there's a slowdown in the market. You got to prepare yourself for this kind of downward. But the key thing in sell-offs is that 90% of the time, stock market recovers in 3 months. You can't really take it seriously. You have to make sure that the fundamentals and whatever you own has earnings projection going up. And right now, we just saw from Exxon. If you buy Exxon as a momentum trade, you got to be disappointed when it doesn't have the earnings, going out next year and the year after. It's you just have to keep track of these earnings reports and earnings estimates. Make sure that even if the stock is selling off, that it has earnings projections going up. And next year, it's expected for a lot of companies to have flat earnings because in a recession, you're not going to be growing as much as normal. So it has to. I think they consider that a mulligan. Everyone's allowed a mulligan in the COVID times. You're allowed to have negative earnings whenever the government shut down. So it's very similar in recession. You're going to have flat to lower earnings, and then you're going to resume your growth rate after that. So, any questions about any of that? All right. The last thing I have to point out, we're still in the December, which is traditionally a good month. So we don't know what's going to happen, but we have seasonality on our side. We're oversold right now, which is a very good indication that any good news with the Fed, we're looking for the words parity, neutral, or we're going to wait to see. And if they say we're going to have more hikes in the next meeting in the stock market, we're going to go back down to here. If it says parity, we're going to break out of this, and everyone is watching this intersection of the moving averages and the downtrend line and the oversold. So we're basically just breaking. We're treading water until we know what's going to go on next Tuesday and Wednesday. All right, that's about it. Everybody has anything to say? Is there any questions anyone has? All right, sounds good to me. Well, thanks for attending, everyone. I hope you have a good weekend.
Thanks, Greg.
Thanks, Greg. You too.